welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky, and we have a very special guest on the line. We have Winthrop H. Smith, Jr. He's the former chairman of Merrill Lynch International, and he is the son of one of Merrill Lynch's founders. It used to be Merrill Lynch, Pierce, Fenner, and Smith?
Yeah, actually, it still is, Joel. Bank of America still kept that name, but that's the right name.
Okay, so your father was one of the founders. When was that, and what was that like, growing up, with your dad, running one of the largest investment firms in the world?
Well, he started with Merrill Lynch when it was only 2 years old. Charlie Merrill founded it in 1914 as a one-man shop, and next year he had a partner named Lynch, and that was really about a 3 or 4 person shop. And my dad, right out of college, joined in 1916. And, he spent his career there. But what's interesting is after the crash of '29, Merrill Lynch actually got out of the brokerage business. They stayed as venture capitalists, and my dad worked for a firm that the Merrills sold it to, named E.A. Pierce in Chicago, as a partner there. And then in 1939, when it was probably pretty bleak out there and it wasn't sure the partnership would continue, he called Charlie Merrill and he said, "I have an idea, and I'd love to share it with you and have you come back into the business." And that was really the founding of the modern Merrill Lynch in 1940, with a strategy of bringing Wall Street to Main Street so that the average guy could actually begin to invest in stocks and bonds.
And, where did they come out with that saying, But,
Well, what they saw, Joel, back then is they saw somewhat similar to today. The public had tremendous distrust for the institutions on Wall Street. They thought only the big guys had a chance. They saw a lot of corruption, inside trading. And they thought if they did business very differently, if they regained the public trust, they could actually get the average investor to invest and actually do it in a way that made sense for them. And I'll give you an example. One of the radical things they did in those days is they took the brokers off of commission. They paid them a salary and a bonus based on how well they did for their client. They took research away from investment banking, made it independent. They trained their brokers before they set them loose on society. And then they gave a tremendous number of just free seminars all over the country to help educate people on how to invest. Something like what Benzinga is doing today in a digital form.
And did you always know that you wanted to go work into the firm? Did you have any aspirations of being a doctor or a lawyer, or was it pretty much in your pedigree that you were going to go into the business?
No, Joel, until I went to graduate school, I swore I'd probably never work at Wall Street. My dad was older when I was born. He was 56, and he died when I was pretty young. I was only 11. He died of Parkinson's disease. And, I thought I would actually be a doctor, and I went to Amherst College. I took my first organic chem course, and I said, you know what? I think I'm going to switch to political science. And then I went to graduate school, got a degree in finance, and it was really in my second year that I got intrigued about the world of investment banking.
And how long were you with the firm?
I was there for almost 28 years. I left in the fall of 2001.
Really? So it must have been, pretty hard for you to witness, the entire financial crisis. You were far removed from the company then, so it'd be very hard to, to understand the inner workings of everything that went on. But in your opinion, you can look at a lot of different factors, the mortgages. What do you think was the single, biggest reason for, for Merrill Lynch having to, basically, a fire sale to Bank of America?
Mm-hmm. Well, I cover that in quite a bit of detail in my book called Catching Lightning in a Bottle, which is, out now, published by Wiley Publishing. And what I said in that book is I believe the reason that Merrill was so successful for so many years is it had a set of principles, and a set of principles that, were really its North Star. That created a culture that was a really dynamic culture. And when a new CEO came in 2001, he had offered me a job of staying there as vice chairman. It was, very tempting. It would have paid a lot of money. But in a conversation with him, it was very clear to me that he never cared about the history of the firm. He didn't understand the firm. He despised the culture. He was going to change it. And I realized I'd be hypocritical if I stayed there. And I said, basically, I'm going to resign. I walked out. And that was a tough day for me after 28 years. But I didn't like the direction it was going. I never thought they could actually bring it to failure. But what happened, Joel, in my opinion, is he got rid of a lot of businesses that had taken decades to develop. And in order to really create the profitability and be competitive with the Goldmans and the Morgans, he took a very healthy balance sheet, over-leveraged it to 36 to 1, jumped in subprime mortgages and CDOs, and essentially brought the firm down. Instead of having a collaborative team where people could, air their opinions, he created a silo mentality. And, basically anybody who didn't believe in it, they were gotten rid of. In fact, the irony was the head of our mortgage department told him to slow down, let's not do this, and he fired him summarily. And that really is, the game, I think, at the end.
And who was that CEO?
That was Stanley O'Neill. There's been a lot written about him, not just in my book, but
Okay.
I think it's pretty clear that he really brought the firm down in 2007.
Yeah, no, I mean it's a really interesting point. You make here. I mean, it must have been especially hard for you to leave the company. I mean, your father, founded it, and there was a lot of history there, and he must have really made one heck of an impression, on you to make that great judgment call. It wasn't on business or how much money you can make. You just you did something based on someone's character, and that's a tough thing to do. I really admire you for that. Just going into this a little bit more, a lot of rumblings about the government engineering the sale of Merrill Lynch to Bank America in the height of the financial crisis, and you had a couple other big ones go down. I'm sure you talk about it in the book. What's your take on that?
Well, I think, Lehman had gone down, Bear Stearns, several months ahead of that time. And that weekend was a terrible weekend. The shorts were hitting the Merrill stock. Merrill was stuck with these positions they couldn't sell. They were just getting marked down by the minute. And it was very clear that even though John Thain, who was the CEO for almost a year after O'Neill, had raised over $50 billion of equity, that wasn't sufficient to save
Wow.
Merrill. And over that weekend, I think they realized that, if they had not made a deal with Bank of America or somebody else on Monday, probably Merrill would have gone the way that Lehman did. And so, he made a deal that looked great for the shareholders of Merrill at the time. And then obviously there were, problems with both Bank of America and Merrill Lynch subsequently. But I think, what history is going to show that to actually be an awfully good acquisition for Bank of America when the history is finally written.
I mean, they had many of their own problems, to begin with. So, I mean, there was a lot, a lot to take in. But I think you're right. I mean, I think in the long run, I mean, if you would have just kept buying and buying and buying and buying the Bank of America stock, it has come back. And is that so? Do you still have stock in Bank of America, or did you kind of wash your hands of everything in 2001?
Well, I would say I was very lucky, Joel, because I didn't like the leadership of Merrill. I was kind of impulsive and said, I don't want to own stock in this company anymore. So I sold 100% of my stock well before 2007, which, is very fortunate.
Wow.
And a lot more fortunate than many of my colleagues who, stuck with it. But I did buy, some Bank of America stock a couple of years ago when it was trading down at the $4 and $5 level. And I just thought if I looked at that, Merrill was worth more than all of Bank of America, in my opinion. So it had to be a good buy.
Give us the name of your book, please.
It is called Catching Lightning in a Bottle, How Merrill Lynch Revolutionized the Financial World. And
Okay.
it's available on Amazon, Barnes & Noble, and published by Wiley.
Okay, yeah, we're getting a few questions in the chat here. So, if your father was still alive, what would be, his comments on the brokerage industry?
Well, first of all, I think he would just be amazed at what's happened to the industry. I think the whole, digital media has created, just a very different environment, which, creates a lot more information to the average investor. So I think he would be, amazed at what's happened there. I think he would be appalled, though, at some of the leadership of Wall Street. And I'd say he would say that they've probably lost some of their compass. They've lost why they're in business. They should be in business for the customer, not just for themselves. And it's kind of interesting, in the 2000 era, you stopped hearing about customers and you started hearing about counterparties, as the big firms really were more focused on proprietary trading than flow trading and really focusing on, the client's interests.
That's interesting. And I mean, basically right now, I mean, you have, your Morgan Stanley and your Goldman Sachs. I mean, Morgan's been a little bit slower to come back. Goldman's had his rough times too. Are those? I mean, do you follow those? I mean, those really is what most closely resembles, the Merrill Lynch of old. I mean, is there anybody else left in that sector?
Well, I think you have to look at them a little bit differently, and also have to look at the parts of the business. I think the private wealth side, for instance, of Merrill Lynch, which is Bank of America now, is doing very well. And I think they adhere to a lot of those basic principles. I think the private wealth side of Morgan Stanley and UBS is very similar, and ironically, it's run by ex-Merrill Lynch people. Now, when you get over to the institutional and the investment banking side, that's where I think, the world has changed pretty dramatically. And I don't think it is the same as it was when I was at the firm, 10 years ago.
Okay, let's shift gears here a little bit and get an outlook here on the U.S. economy. Sheldon McIntyre of Herd Capital, a frequent contributor to our show, is curious to hear your thoughts on Fed policy since 2008, and what is your short and long-term outlook for the U.S. economy?
Well, I think, there can be a lot of criticism about what the Fed did, and I know there are a lot of people who think that it's going to lead to, inflation in the future, but, it's easy to be a backseat driver. I think the Fed and Bernanke was looking at an ultimate meltdown there. I think what they did was absolutely essential. I think it's worked out well. I think it is helping our economy to recover now, and we are seeing the economy recovering. I'm a little bit different today. Instead of sitting in Wall Street, I sit in the microeconomy here in Vermont. And I can see the economy from a very different angle. And there still is a lot of confidence that needs to be rebuilt. There's still, while there's a lot of liquidity, not a lot of that liquidity is still flowing down to small businesses and to the individual. So I think the Fed, staying accommodative for a period, a longer period, is probably what's needed. But, the U.S. economy is leading the rest of the world right now. It has some things the other parts of the world don't have. And I think, the U.S. economy over the next few years is going to be quite strong.
And it just seems that no matter what else is going on in the world, it just seems like, our market just continues to plow ahead. Whatever's going on in Europe or Japan or China or Russia, it just is impervious and just continues. What do you see as the biggest detractor to the bull market in 2015? I mean, we're going to do our Fed forecast on Friday, and we're going to talk about interest rates. But it just almost seems that anybody thinks that interest rates are going to do a reverse course and go straight up like they did in the 80s needs to have a second thought. What do you see standing in the way of the bull market in 2015?
Well, unfortunately, it's always the surprise that you don't anticipate that is the wreck out there, whether it's the internet bubble boost or, the 2001. So there's always something lurking out there that is going to be the issue, and we probably don't see it today. I'd say before the election, I was beginning to worry about bad regulation. I didn't think Graham Dodd was a particularly good bill. There were good parts of it, but I was beginning to worry about over-regulation and over-meddling in the free economy. That may now be less of an issue with the new Congress coming in.
Okay. And so tell us, I mean, you wrote your book, so tell us what you're doing now.
Well, I've taken a second career. When I left Merrill, I bought Sugarbush Resort up in Vermont, which is a pretty famous ski resort. We've been rebuilding it over the last 10 years, so you could really say my second career is a ski bum. I've already had my first two runs of the morning before this call. I'll go out right after that. And so that's been really a fun second career after leaving Wall Street.
And you're still a director of 4 financial firms in U.S. and Canada. Can you tell us what firms those are?
Sure. In the United States, it's Eaton Vance, the money
Okay.
management firm. And in Canada, it's AGF, which is another asset management firm, Richardson GMP, which is a private wealth firm, and then also Richards Financial Group was a private family company that is a part owner of Richardson GMP.
So if we come out to Sugarbush Resort, can we get a little discount there on our lift tickets?
Sure, you can absolutely come up and see me. And actually, it's very much like the airline business. There's so many ways of skiing today and getting good deals, especially if you go online and follow.
Okay, and we just have a few minutes left here. Do you have any favorite sectors that I'm not going to ask you for specific stocks, but do you have any favorite sectors that maybe you've had a long history in and investing and are continuing to look at positively, or something like oil stocks? I mean, the oil sector is just, I mean, I bet you in over your years in the market, you haven't seen crude take a haircut like this. Is that catching your fancy at all for a possible investment?
Well, I've seen an awful lot of volatility in, oil stocks over the years. I can remember some of the bashing that took back in the mid 70s. But yeah, I think probably oil has been hit awfully hard. The price of oil today, whether it's $54 a barrel, that's probably not sustainable long term. So I think there are some very good values to look at that, especially if you have a little bit of patience. And financial services I don't think is overvalued either. I think there are going to be some continuing good values to see there.
Okay, and any sectors that you would be, that you always have avoid or would avoid, in upcoming year or so or long term?
No, I wouldn't say there's any sector. It's probably I've always found it a lot more difficult to understand technology, and it's probably an area that I've been always a little bit cautious of, and probably have given up some good opportunities. I have owned Apple for a while, so that's been a great stock to own and to hold for certainly the last few years.
And final tips for investors.
Well, the tip I would always give people when you're looking at companies, I don't think enough is made of the character of leaders, and I think that's the issue that brought Merrill down. And I think when you look at the fundamentals of the financials is important, but really understanding who the leader is and how they're managing and whether they are really building the company the right way is terribly important.
Okay, starting from the top down, and that certainly gave you a clue in 2001, and probably avoided a lot of heartache and aggravation, 7, 8 years later. But interesting point. Winthrop H. Smith Jr., former chairman of Merrill Lynch International. He's written a book, Catching Lightning in the Bottle. He's also a majority owner and president of Sugarbush Resort in Vermont, as well as a director of 4 financial firms in the U.S. and Canada. Well, thanks a lot for coming on, Winthrop. It's been, a great conversation. I never thought I'd have the opportunity to speak to one of the sons of, the founders of a prestigious firm as Merrill Lynch. We've enjoyed having you on, and we'd like to have you on again.
Thank you, Joel. I hope I'll see you up here in Vermont one day.
Okay, thank you.
Thank you. Bye.